Where has this figure come from? This figure has come from here. Have you seen the figure? Team members, if we throw away the 3 zeros, have we seen my team members?
Yes, we have.
Yeah, so that is the figure there. That is our figure there. Okay, some people are coming on. So that's our figure there. Then this figure is supposed to grow at what rate? Have you seen the rate of growth of the figure? What's the rate of growth? That figure will grow it at what rate? Anyone can help us there? What's the rate of the growth of the figure?
At 5.8.
Yes, you are right. You are right.
Yes.
Okay, so I'll grow my figures here. You as well, just test, make sure that you're able to get the same. 1.058. If you notice what I've put here, I'm multiplying by 1.058.
That's how we're going?
Let's go to the next one. What's the operating profit margin? The operating profit margin is 30%.
30%.
The operating profit margin is 30%. So we're going to apply 30% on each one of those figures. That is what we are going to do. So let's apply the 30% on each one of these figures. That's where we are. So 30% of each one of those figures. Okay. Coming to the tax, we had established a tax, so the tax is 28%. The tax is 28%. Let me just indicate in my worksheet. %. That's a tax at 28%. I hope we have people out there who have set up their worksheets.
Mr. Iri.
Yes, please.
I just wanted to know one tactic that you use. The brackets, how do you put the brackets in there? I've tried to do that, but it gives it just minus on my worksheet.
Yeah, that's a good question. Actually, my worksheet does that. I know some spreadsheets do. Some you need to go to format to format them for you to pick the brackets. The one that you're going to use in the exam doesn't do the bracket as well. The one that sits on the ACC doesn't use the brackets, but it does the commas. You can do the comma.
Okay.
Yeah.
Well, that's fine.
Okay. Good question. Because it looks nice with the brackets, Mr. Mfwe, doesn't it?
Yes, it does actually. It does. With the minus, it looks awkward.
I agree with you. It doesn't look good, actually. I don't know why they haven't put it. And you know, normally that's what we do in accounting. When you're subtracting, we do a bracket. So everybody understands what you are doing, you know. But a minus, you may not even see what's happening. What
Mr. Piri?
Yes, madam.
Sorry to go a bit off the lecture, but just while you are still on that topic, I have a request.
Yes.
For me personally, I haven't sat exams in a long time.
Yes.
So I was just kind of asking if there's a way in which we can be kept abreast with like what has changed regarding the exams. And just like you've mentioned, if we are using Excel, what's different and what we need to know. Basically just an update.
Yeah, this is Madam Banda, is it?
Yes, it is.
Okay, fine. Yeah. So the current exam is all computer-based, the CBE. So what I'll do is, I think in the next session, I'll just ask for somebody to give me the login details so that I can log in and they can walk you around the computer-based environment, CBE environment. So I'll just
Thank you so much.
I'll walk the whole group through the CBE environment so that you can we can see how to get around it. But I also engage you one-on-one on that item.
Thank you so much. I highly appreciate.
Thank you. The CAPEX to grow operations. The CAPEX to grow operations. What are we taught about the CAPEX to grow the operations? Let us follow through. That's an important item when you're doing free cash flow. That's an important item because that's what makes this to be a free cash flow. It's when you knock off the routine capital expenditure items. The combined company require additional investment in assets of 513. So this is what we call the routine capex, 513 in the first year. What of after that? It's 18 cents per $1 increase in sales. So you calculate the increase in sales and multiply it by 18 cents or 0.18. That is what we are going to do. Let us see if all of us can do it correctly. Let us see if all of us can do that correctly now. So for the first year, they have given us the figure. What for the next year? Here, you need to get the increase in revenue. 54,965 minus 51,952 multiplied by 0.18. So for this one, we say 54,965 less 51,952. Then you multiply your answer by 0.18. Okay, so you've got somebody there has got the answer there. There we are. There we are. And with this, you are done with the cash flows. I'm sure you are starting to see that there's no big deal really about free cash flow. No, I agree with you. There's no big deal about free cash flow. From revenue, we can see now the route we have followed. From revenue, we got our operating profit. Then we knock off our tax. We knock off our capex. Then you have a free cash flow to firm here. So your question is, so where is the issue? Where is the work, Mr. Piri? The work is here. That's where the work is. most of the marks actually will go to the discount rate. This is where the work is. So one of the highlights of our discussions this afternoon really is to move slowly on how to find the discount rate. One of the things that you'll be able to take away and also use on other questions is how to get the discount rate. So now let us go through calculating of the discount rate. Let's go through the details. Okay. Number one, these are free cash flow to firm. So the discount rate that you are looking for is the WACC. The discount rate appropriate to this situation is the WACC. And you know that to calculate the WACC, you need the cost of debt and the cost of equity. We need these two. And also the capital structure. And also the capital structure. So these are the three items that we need. So in our discussion, we're talking about these three items. Okay? In our discussion, we're talking about these three items. Let's go for the easiest of these items. The easiest of these items are, one, the interest rate. Now remember, I think it was somebody who asked me a question last time, Mr. Piri, how do you know this figure is pre-tax? I think I did give an answer. I said that the interest rate, the annual interest rate, which is quoted for you by the bank or financial institution, is pre-tax. They don't know your tax position, what tax you pay for them to start reducing that figure from there. So this figure is pre-tax. So the cost of debt then, in this case, it will be 6.4 brackets 1 minus 28%. So that's your cost of debt. That's your cost of debt. Okay. So you may say, this one is not an issue. Mr. Piri, yes, not an issue. That's straightforward. What are the capital structure of the combined company? When the companies have been combined, what is the capital structure? Now, the issue of the capital structure of the combined company is something that was mentioned several times in this paper, on the question paper itself. In the question requirement, they say that assuming that the combined company's capital structure stays the same as that of Pursuit's current capital structure. So where is the Pursuit's current capital structure? Can you all see it? It's here. So Pursuit's current capital structure is the one that we are going to use, is the one that we will apply to the combined company. And this sort of an adjustment, you're going to find it again and again. There's nothing to panic about it. This sort of an adjustment is going to come again and again, where we're told that for the capital structure of the combined entity, make this assumption. Normal assumption is the parent company capital structure. So we're going to use 50-50. So then, so far you can say, okay, we are okay with the cost of debt. We're also okay with the capital structure. We can argue that with these, we are all right. So So where is the issue then? The issue is on the cost of equity. That's where there's more marks and there's more weight. What approach are you going to use? We can see that there's a mention of the beta. The issue of the beta has been mentioned several times. Beta has been mentioned. And also when you look at, like we did last time, risk-free was given. The market risk premium was also given, which is it was also given. So these parameters were given. All these were pointing to the fact that what model are we supposed to use?
CAPM.
Yes. And in the CAPM, certain things are very obvious in the question. What things are obvious in the question? The question has given us risk-free. The question has given us the premium. So risk-free is a 4.5. That one is your 6%. The problem, not only in this question, but in all the other questions you are going to do, the problem will be here. So even the markers, when they are marking, they don't even waste time to look at other things. As you can see, there's no issue on capital structure. There's no issue of cost of debt. The examiner will, and there's no issue on other variables. What the marker will be marking is, does the candidate really know how to get the beta? The appropriate or a suitable beta, do we know how to get it? Now, they have given us information. Let's follow through on the information that we are going to use, okay? So here now, let's forget about everything else. Let's tell ourselves we want to find the beta. That's all. Once we find the beta, cost of equity is over. Now let's check about what they have said about the beta. In the question requirement itself, let's see. Okay, more specifically, here we are. This statement that you see here has been repeated several times on our exam. What is it? The beta of a combined company. This statement that is here, you can take it like a statement that applies in almost all situations for this examination. So what does this statement say? It's here, I've circled it for you. It can be assumed. It can be assumed, that's the assumption you're going to make. But the asset beta, asset. Please take note of the type of a beta we are talking about. We are talking about an asset beta here. We're talking about an asset beta. Can somebody remind us, what does the expression asset beta mean? What type of a beta is an asset beta? Yes, somebody has given us the correct answer. This is a beta which is not geared, ungeared beta. of the combined company is a weighted average, not a simple average, no, a weighted average of the individual company's asset betas, weighted in proportion to individual companies' market values. So what are they talking about here? We're now looking at a combined company. We want to find the beta for the combined company. That's what we're looking for. So the question says, first of all, you take the beta of the individual companies. Get the individual company beta. So we are going to go to F, get their asset beta. We're going to go to P, get their asset beta. And after we have done this, we are going to find the average of these two. Simple average? No, we're going to do a weighted average. This you're going to do in many other questions. Where to find the beta of the combined company, they'll give you information about it, the asset betas. And that first of all, you get the asset betas, you average them. Then you're going to get the combined company's asset beta. I hope we have followed those steps. That first of all, we need asset betas. And then we average them. The next step is, how do you convert an equity beta into an asset beta? How do you convert an equity beta into asset beta? Why? Let's talk about it. It's because in our question, what type of betas have been given? Let us look at the type of betas that have been given in our question. In this question, they have given us, for Pursuit Company, they have given us a what? An equity beta. So this equity beta has to be converted to an asset beta. It's 1.18. Similarly, when you look at the F also, what has been given? We've also been given another equity beta of 1.53. This has to be converted to an asset beta. So to me, this arrangement of a free cash flow is not a question. That one is straightforward. Now you have seen what is involved. And that won't give you problems. The only place where you may even spend a bit of time is this issue of the beta. This issue of the beta. So now let's answer the question. How do you move from an equity beta to asset beta? The simple answer, of course, is that we use a formula. The simple answer is that we use a formula. We use a formula. How does the formula go? The formula which is given in your exam is your asset beta equals the equity beta. Then you multiply by your value of equity over the value of equity plus the value of debt, 1 minus T. That's what you do. That's what you do. So you see, this is not a difficult formula, no. And the good news is that you're going to do this again and again and again. So you become an expert. You become an expert. So let us try it. For Fodder, everything is here. Let us try it. Let's try it. So our asset beta for Fodder will be 1.53 multiplied by the value of debt to equity. So debt is 10, equity is 90. Debt to equity, 10 to 90. So this one is, and that one is equity. So let's go. We multiply by 90 over 90 plus 10. 1 minus t, our t is 28%. So that's it. What we have. So what is our asset beta? Is there a potential for a mistake? Let's discuss a potential for a mistake. When people are simplifying here, some people, they start by here. They say 90 plus 10. They multiply by 0.72. That is wrong. The correct approach, you start from this side. 0.72 multiplied by 10, that's 7.2. Plus 90, that's 97.2. So now you go 90 over 97.2 multiplied by 1.53.
$1.142.
Come again?
1.142.
1.1.
1.42.
1.142.
1.42.
Are we all happy with that?
I've gotten
I'm getting
1.42.
1.42.
1.42.
1.42.
Yes.
Like this one?
Yes.
Exactly.
Yes. This is an asset beta. Now, some people may say, no, but some of us were not happy about that. Okay, we'll give you another chance. We'll give you another chance. There's another one here for pursuit. Let's look at pursuit. Pursuit is here. The equity beta is what? 1.18. Their capital structure, debt to equity is 50-50. So let us do our multiplication then. So then the asset beta will be 1.18 multiplied by 50 over 50 plus 50, 0.72. What answer do you get? What answer do you get? 0.116. Come again?
1.16.
1.16.
Yes.
0.689.
Let's be careful. 50 multiplied by 0.72. Then you add it to 50. That's the way to do it. Not 50 plus 50 multiplied by 0.72. 50 multiplied by 0.72, you add it to 50. That's what you do.
It's 0.69.
0.69.
True.
Good. You know, when a question comes, this is where, that's what the marker will be looking for. The marker will be looking for, that's where the marker will focus the attention. Now with a computer-based exam, you need to know how you're going to arrange all this before you go to the exam. The arrangement of these figures is standard. And if you're going to try it in the exam, it will give you problems. But here is a place to know, how am I going to use, how can I use a spreadsheet to put in this? So let us see what I've done now.
Mr. Perry, just there.
Yes.
Is it okay? Okay, that's what I've been doing on the spreadsheet.
Yeah.
Now that's what I've done. Is it okay? What I've done, like on the second one and even the first one, I've put 1.18 times bracket 50 stroke, that is over 86. If you calculate in advance the 50 times 72%, is it okay?
Yes.
You can't be penalized on that.
No, you won't be penalized.
Okay, all right.
Penalized. So here's what I did. This is how I arrange my data here. Are we happy?
I have a question. Sorry to interject.
Come again?
I have a question.
Please go ahead.
So for all of the practices that we have been doing of the questions, I've been going into the ACCA site and doing these questions there in the test page. And I've noticed that you can be able to do calculations using the spreadsheet, like to add and to subtract and all that. Would you advise we use but the formulas are really limited. Would you advise that we use the inbuilt calculation or calculator in Excel in the exam portal, or we actually still use our calculators to double check the figures? That is during the exam.
I would say go for what is faster and go for what you're going to practice. And this is what now exam preparation is all about. Exam preparation is not just knowing what is asset beta or equity beta, no. Exam preparation goes beyond that. Exam preparation goes now to what we are doing. In the exam, if this question comes, what am I going to do? Am I going to use a calculator which will come with the package, the question paper, or am I going to use my own? That decision has to be made now. In the exam, there's no time to make such decision. It's more like, you see what I've done here, like these items I've put here. It's not really necessary to put all this. I use this for teaching purposes. But if you have done this several times, if each time you are ungearing, you're using this approach, this will become your second nature. So you can practice that. This is what I'm going to put. If you put everything and there's a formula there, that is also acceptable. So you're doing very well that you are counter checking with the spreadsheet that is in there on the CBE. Is that okay there?
Yes, thank you.
So exam preparation is not just about you learning what is asset beta. What is equity beta? Yes, this is important, but exam preparation is what am I going to do in the exam? And once you have a format, consistently use the same format. So we have calculated the asset betas. What's the second step? We need to average them. We need to average them. So let's go. How do we average these? They have told us what to do, haven't they? they say we must get a weighted average. We must get a weighted average. That's what they have said. So the question is, where do we get the information? Well, how do we proceed with the weighting? How do you proceed with the weighting? We look at the values. What are the values? The values of the two companies. Where are they? One of it we calculated, so let's pick them. For P, they've given us here the total market value. This they have given us. Okay, so we pick that. For F, we have calculated ourselves. We have calculated ourselves, we are here. That's the 40 million. So with this information now, we can proceed. With this information now, we can proceed to find the weighted average. So the weighted average now is here. So the weighted average is here. The value of P is 140. The value of F is 40. The total is 180. Okay, so for P, as you can see, for F is 40 over 180 multiplied by 1.42. For P, it's 140 over 180 multiplied by 0.69. Are we happy with the weighted average? Are we happy with the weighted average? How the weighted average has been calculated? So the answer is 0.85. This is the asset beta for a combined company. Have you finished your work? No, unfortunately, you haven't. Why? Because the combined company has got debt. Has got debt in its capital structure. So this asset beta that you have calculated, this asset beta, you need to re-gear it. Using the combined company's capital structure, which is 50-50. So how do we re-gear? The same formula, remember? The formula that we used was the asset beta multiplied by the value of equity over the value of equity plus the value of debt, 1 minus T. Now this time around, you want the value of equity beta. So what do? You get your asset beta and you multiply by that's what you do. We're just turning this upside down. If you notice what we are doing. All we are saying now is this goes down and this goes up. That's what we have now here. As you can see, this is your 0.85. The value of equity, remember, is 50. This is 50, and this is 0.72. And here it is 50. That's called the re-gearing. And if that is correctly done, your conclusion will be that the equity beta for the combined company is 1.46. And this is a small figure which has taken us so much time. This is the beta that we are supposed to use. So if you notice, this is what the question is, isn't it?
Yeah, true. That's why there's a lot of work.
That's why there's a question. The good thing is that it's repeated a number of times. It's not like in many questions this will come up. You're going to see the question we'll be looking at tomorrow. This will again arise. What we must do, all of us, is to learn how to arrange the figures. Worksheet, because we have finished the work now. So I'll share this worksheet. This is a small figure which has cost us, taken all our time this afternoon. So where do we take this small figure? Where do we take this small figure which has taken all our time? We bring it now to our final computations. There we are. With that 1.46 now, we can comfortably calculate what? The cost of equity. Where is that small figure? It's here. The cost of debt, we have talked about it already. The capital structure, the 50%, we have spoken about that. And once you do that, finally you have got your discount rate. So this is the discount rate. So this is our discount rate. This is our discount rate. Okay, 8.909%. If that is okay now, let's say start closing down our session. Let's start the close down. So now I'm sure we understand what all this means now. So there we are. These are discount factors. We discount and we get what we're looking for. Let's look at the terminal value. Let's look at this story here. That's a story of interest. Remember from the last class, this story was quite an interesting one. Okay. From our last class, this was a story of interest. Let's go through it again. Let's go through the story. So we take this out as our free cash flow. Here we are. We grow it by one year. Remember, they say that the growth afterwards will be half of 5.8%. So that's our growth factor. That's our work. That's our growth factor. So if you do that correctly, you get that. Remember, your value to them is free cash flow after 1 year divided by the work minus the G. This is what we are doing here. Then as we said, the discount factor for year 4 is the one that we apply here. So to discount, to find the present value. So the value of the combined company is 189,168. The question is, how are we going to answer the question that we are asked? Now let me just confirm. Are we happy with this value today? Especially what is involved in getting the value after the first 4 years. Do we have questions on that element? Last time we had a number of questions. Okay. Now let's answer the question that was given. That's the interesting thing, eh? We haven't answered the question. The question was, evaluate where the acquisition of F would be beneficial. Is it beneficial? Here is now the way we conclude our answer. If these companies continue to operate, independently, their value is here. If we combine them, the value is there. So there's an acquisition premium. There's a profit, or there's synergy, gross synergy. There is gross synergy here. What is a gross synergy? 189 minus 168. Is this good enough for our shareholders? Let's do the analysis now. Synergy on profit, 189 minus 180. How much premium have we agreed? There's a proposal. Let's look at the proposal in terms of what premium we are going to pay out. There's a proposal. What is a proposal? Let's take the proposal here. The proposal as things stand is Bestwood Company estimates that the payment of the equity value plus a 25% premium, meaning you go to Fodder. You take the value of equity plus a 25%. That's what they will accept. So we need to find out how much is this premium? How much is it? Let's find out how much it is in our computation. Then you can tell me whether this acquisition is worthwhile. Then you're going to tell me whether this acquisition is worthwhile. The premium that is being implied is, remember, the total value of the company according to our computation. The total value is 40,096. This is what we have calculated ourselves, or we have estimated as the value of Fodder. So total, meaning that debt plus equity. This total simply means that it's debt plus equity is what gives us 40,096. Equity is 25% of that. Sorry, equity is 90% of that. So you take 90% of that. And this is 90% you see here. Now, some of you say 90% where the capital structure of the company is 10 and 90. So 90% of this is equity. So that's the value of equity. Premium is 25% of that. 9021.6. So we're saying that out of the total profit of so much on combination, this will be paid out as a premium to the shareholders of F. So out of this combination, what will remain as the additional value for shareholders of Pursuit is only 50. And because these are thousands, it's only $50,000. Now the question comes to you. Do you think this combination creates additional value for the acquiring company? What is your answer? Imagine you are the shareholders in Pursuit. What would be your reaction? Want your reaction? Want your reaction?
Can you repeat your question again? Repeat your question. I think.
The question is, do you think this acquisition is acceptable to the shareholders of Pursuit? Do you think it's attractive?
I would personally like to believe that it is acceptable, because at this point we are looking, the synergy profits is quite fair, meaning that if we look at the future profits, then we are obviously, the shareholders will actually be making more than the current 50,000 that will be made in the current financial year. The reason why it's a bit lower in the current circumstances is because of the premium. And again, there could be other additional benefits to the shareholders besides the actual money terms that we are looking at right now of the 50,000 that will benefit the shareholders in future and not in the current financial year of acquisition. That is how I would have answered it.
Well done. Thank you very much for that. Well done. You have justified your answer by talking about other factors that, no, look, for you, you think it's okay because of other factors. Okay? Especially if these other factors, you can pick them in the case. You can pick them from there later.
Especially on the first paragraph, in the first paragraph where it highlights that the first paragraph talks about, just a minute, the first paragraph talks about the first paragraph talks about when you look at the company they're acquiring, which is Fodder. This is an unlisted company, but is involved in development of sophisticated by high-risk electronic products, which means this could be penetrating other markets where they may need these sophisticated electronic products. And that on its own, the profitability may not be seen now, but as they penetrate the markets, they will start reaping from that.
Okay.
And also looking at the resources that they'll get, human resource or human capital that they'll get from Fodder. That also may add to the advantage.
Excellent. You've done a good job, guys. So there's no one answer here, no. What is coming out from your, if I combine what you have said, you say, the only problem seems to be the premium. If we take out the premium, or if we negotiate the premium properly, some value may remain here. So my answer was, I doubt, considering there's so many assumptions. There's too many assumptions that have been made, and this 50 looks small. If there's just a tilt, this can even become a negative. There are so many assumptions. Those growth rates, they may not be correct. So this is not the only answer, no. This is not the only answer. The other people are saying yes, especially if we renegotiate the premium. If we renegotiate the premium and look at other benefits, like the complex electronic products, this may still be acceptable to pursuit shareholders. Excellent, well done, guys.
Mr. Piri, just
Yes.
a question on the same one. Like the way they've said that it's the 25% of the value of the equity.
Yes.
That they want as the premium. Yeah. So in this case, we're talking about like if they are to accept it, like what we said is, if they are to accept it with the current situation, yeah, they need the total value of the equity plus the premium as 25%.
That's when they will accept to sell their shares.
Okay. Okay.
So
which the premium, which is this one that we calculated of 9,000.
Yes, this one.
Okay.
This is the premium. So from this profit, we're removing this premium. So what will remain for pursuit shareholders is only that, which is the 50,000 really. $50,000. So going by this premium, this is where the problem is. This is where the problem is. And should they increase, should they demand more? Because sometimes they can even demand more. Then you are saying this deal may not be good for us. So what do I want you to do now? What I want you to do is take this question at your own pace. After I've shared the spreadsheet, go through it again, understand what we have done, and try to see how you can set up these computations on your own again. I'll be sharing a question for tomorrow. And I've been told by somebody that the recording from previous classes are helpful as you are preparing for class. I was told, I've been reliably informed that the recordings from the previous classes are quite useful. So for the question that we'll be doing, I also attach a recording so that you can go through it in advance. And that one is a 25-mark question. So it's much shorter. You go through it so that you get well grounded in the concept of evaluations. So I'll share the question paper. I'll share the recording also for tomorrow in advance. If that sounds well, that's where we end today. We'll see you tomorrow. Our time tomorrow is 16 hours.
Thank you, sir.
Thank you so much.
Thank you so much, Mr. Piri.
Thank you. Bye.
Thank you.